Alright, welcome back everyone. People are constantly asking me which is better, owning physical property or investing in REITs. Today, I'm gonna break down both sides and help you figure out which path is right for you. But stick around to the end because I'm going to share exactly what I own in my portfolio, both my properties and REIT positions, and how I've structured my strategy to stay balanced across both. Real estate is the #1 way to build wealth. Andrew Carnegie famously stated that 90% of millionaires acquired their wealth through real estate. Even if this is an exaggeration, it's hard to deny that more millionaires are made through real estate than any other investment tool. No, I'm not saying it's the only way or that it's even the best way. I'm just a guy on YouTube and this is not financial advice. It's just my perspective and what I'm doing. Alright, disclaimer out of the way, and now let's get to the show. First, let's talk about traditional real estate, the hustler's game. And let's start with owning physical property. Now, a lot of people think buying a rental is an easy way to make passive income. Trust me, it's anything but passive. I own 4 properties, 2 in Las Vegas, which are long-term rentals, and 2 in Joshua Tree that I run as short-term rentals on Airbnb. I also owned part of a 30-unit portfolio that I'm no longer part of because the passive income we talked about, not quite as passive, but that's for another video. On paper, my current portfolio sounds great, right? Collect rent every month and watch the property appreciate. But in reality, it's a grind. I've had months where an unexpected repair would wipe out all of our real estate rental income. I've dealt with tenant issues, vacancies, late payments, the whole nine. And don't get me started on how short-term rentals can be a roller coaster. It all depends on the season. That said, here's a major pro when you're buying properties. Property loans are secured against the home itself, which means you can use creative financing. I've seen people get into properties with little to no money down, thanks to strategies like seller financing, lease options, or even leveraging equity from another property. You can't do that with REITs. With real estate, you have access to these kinds of tools that let you expand your portfolio even if you don't have a ton of cash up front. On top of that, the control you get with physical property is huge. You can improve the property, you can raise rents, and you can eventually sell when the market's right. If you play your cards right, you can build serious wealth with real estate. That's why, hence the 90%. REITs. This can be seen as the lazy investor's dream, but not really. Now, REITs, which are called real estate investment trusts, sound like a dream for people who want exposure to real estate without the hassle. You buy a few shares and boom, you've got a slice of commercial properties, shopping centers, even hospitals in your portfolio. No tenants, no repairs, no midnight calls, no changing toilets, none of that, right? But it's not all easy money. REITs are still tied to market performance, and when real estate struggles, so do your REIT shares. Take Realty Income for example. I've held it for years and love the steady dividends, but I've also watched its price fluctuate. Same goes for Agree Realty and Federal Realty. And here's a key difference. You need money up front to invest in REITs. You can't use creative financing to buy shares. Sure, you could buy REITs on margin, but that's extremely risky because you don't have the level of control you get with traditional real estate. The market can move against you, and you can't jump in to fix up the property or improve its value. With REITs, you're a lot more hands-off and dependent on external factors like these companies. So the trade-off, that's control versus convenience. Which is better? It really depends on what you value, control or convenience. With rental properties, you're hands-on, making decisions and dealing with everything that comes with owning physical real estate. If you love redesigning like I do, interior design, that might be good for you. But with that comes the opportunity for serious equity growth and creative ways to get into the market with less cash. I was able to use creative financing and I was able to grow a pretty large portfolio without too much investment. On the other hand, REITs offer convenience. You don't have to manage anything. You get a steady dividend, but you're not at the mercy of the broader market, and your upside is more limited compared to property appreciation. But no toilets, remember. But there's also no creative financing here. It's all your money up front unless you want to take the risk of margin, which I do not recommend. So, my approach, why I invest in both. Here's how I approach it. I invest in both. My 4 properties give me that steady rental income and long-term appreciation, while my REITs balance things out with a more hands-off, diversified approach. A strategy I deploy is using some of the profits from one to feed the other. For example, I sold our primary home in the Bay Area that we rented out for a few years. We kept it for that rental, but eventually sold it for a massive profit. What did we do? We reinvested some of the profits into Joshua Tree and invested the rest in stocks and REITs. So by having a strong traditional portfolio, it helped us diversify and grow our other income streams as well. Remember that 90% of millionaires we talked about again? Most don't stick to real estate. They use it as leverage to invest in other streams of income. But as promised, let's get into my portfolio. So again, my Las Vegas properties are long-term rentals, providing consistent monthly cash flow. It's a good market here. I can rely on rents every month. My Joshua Tree properties are short-term rentals on Airbnb, which is a bit more volatile, but we've seen some amazing seasons which have covered our costs and then some. As for my REITs, here's a breakdown of my portfolio. I used to have a lot more than this, but I've actually consolidated some of my investments just to make my portfolio easier to manage. All right, Realty Income, ticker symbol O, 1.94% of my portfolio. Steady dividends, but you've got to keep an eye on market fluctuations. They have a balance of residential and commercial. Federal Realty, ticker FRT, 0.58%. A smaller position, but strong in the commercial real estate space. Rhythm Capital, ticker RITM, 2.67%, a larger chunk, providing great exposure to different types of real estate investments, not just properties, but loans, things like that. And Agree Realty, ADC, 1%, strong performance this year, and I'm adding to this position because I like where it's headed. That'll likely be closer to 2 or 3% by the end of the year. So I invest in both because they serve different purposes. My properties give me control and long-term growth, while my REITs add diversification, liquidity, and dividends around 4 to 5% annually, which doesn't include the actual price appreciation of the stock. It's about finding the right balance. So, which should you choose? What's better for you? Traditional real estate or REITs? Well, it all comes down to your goals, timeline, and how hands-on you want to be. If you want control and you're willing to put in the work, owning properties could be the way to go. Especially if you don't have a lot of money to invest right away, you can get creative. But if you want the convenience of passive income without all the headaches, REITs might be much better. Let me know in the comments below what you're leaning towards. If you found this helpful, make sure to subscribe. I've got more content coming that dives into even deeper into real estate investing and my other investing strategies. Thanks for watching. Again, please like and subscribe if you haven't already. Take care, and I'll see you next time. Boom.